The Justice Department is playing hardball, Wall Street banks are wooing children in China, and we ask, what would Warren do? You're in the right place, folks, because this is where the money is. David, over at the Wall Street Journal, there's a headline today. The Justice Department plans new crisis-related cases, and I'll read you a quote here from that article from Eric Holder. He says, "My message is anybody who's inflicted damage on our financial markets should not be of the belief that they are out of the woods because of the passage of time. If any individual or if any institution is banking on waiting things out, they have to think again." Tough words from Eric Holder. But my question is, when we think about this from an investing perspective, what should our readers and viewers make of this playing hardball?
I think you hit it right on the point there. Say from an investing perspective, I think it was a couple months ago, Eric Holder, he was the one that came out and said maybe these institutions are too big to jail and you can't prosecute them because it could damage the economy if you scare investors, scare bondholders in that area. From an investment perspective, I don't think it's that big of a deal. We were talking before the show, and I don't see these fines being big enough to really hurt book values. I think that was your point there, and I would agree with it. This isn't going to be totally destructive to these banks. There'll be settlements, there'll be fines, but I don't think it's enough to change the thesis of buying a bank for the next 5-10 years.
I think it's noise. I think the Justice Department is fighting previous battles. I think if they wanted to make a difference, they would go after individuals who are doing things illegal or out of the norm to really set a precedent that next time around, somebody who is responsible is going to get punished. It's not going to be punishing investors who may or may not have been investors at the time, punishing executives that may or may not have been, probably weren't executives at the time. It's just these cases I don't think serve the purpose that the Justice Department wants them to. So not only do I think that this is basically a non-issue for investors, but I also think that that the Justice Department needs to rethink how it's approaching this.
And you're seeing the reaction in the stock prices too. I know we don't like to look at daily stock prices too much as a barometer of what's going on, but if this really was a huge deal and massive reserves are going to have to be set aside in excess of what they already have, then these stock prices would be taking a hit, and they're kind of just whatever. It's the news, they hear it, investors hear it. I don't think too many people are trading on this news, and I would agree with that. I don't think you should be trading on it. I don't think you should be investing based on this news, so it's kind of just a side story.
Over at New York Times Deal Book, headline is "Many Wall Street Banks Woo Children of Chinese Leaders." This is not a true hiring children thing. This is hiring the sons and daughters of Chinese leaders. Of course, we saw the news earlier this week, or I guess really late last week, that JP Morgan is getting a close look from the SEC here in the US about its hiring practices in China and whether it constitutes bribery. This from the Deal Book's article. The grandson of former Chinese President Jiang Zemin once worked for Goldman Sachs. The daughter of former Prime Minister Wen Jiabao used to work for Credit Suisse, and in 2006, the son-in-law of Wu Bangguo, then a member of the Politburo of the Communist Party, helped Merrill Lynch win a deal to arrange a $22 billion listing of the state-owned banking giant ICBC. So when we think about this, and this doesn't surprise me, it's kudos to Deal Book for getting this information together, but this is exactly what I expected. This is what I expected was going on in China broadly. But I mean, hiring well-connected people, hiring sons and daughters of well-connected people in powerful positions, this happens all over the world. So it wasn't surprising to what was surprising to me about the JP Morgan thing was that this is making the noise that it is.
Yeah, it's really just this witch hunt of JP Morgan, if you will. This stuff I'm sure is going on not just at banks, but at every multinational company to some extent. I mean, I don't have evidence backing that up, but I'm sure if you're looking for these types of things, think about JP Morgan. They have all these entities, all these regulators turning over every rock, trying to find anything to scrutinize JP Morgan about. If you looked at Coca-Cola, Procter & Gamble, I'm not implying that anything shady is going on, but if you really looked at any of these big multinational companies, I'm sure you could find some things that are maybe questionable, or ethically, maybe not illegal, but questionable.
I'll one up you there even more. I think that if the government decided it was going to take a really close look at Berkshire Hathaway, probably my favorite company, and one that I think is run really well and run with sort of a moral obligation from the top with Warren Buffett. But I think if the government decided it was going to take a really close look at Berkshire Hathaway and all of its various entities, you would find things, or they would find things that would be
not necessarily illegal, but just make good headlines. And
yes, look untoward.
Right.
They would look untoward. Finally, at the FT, the headline is "Intern Death Leads to Calls for Shakeup of City Bank Culture." This is relating to Bank of America over in the UK. There was unfortunately an intern that died after working three straight all-nighters is what they're saying. Here's a quote from the article. "Banks in the City of London are facing calls to overhaul the working culture for younger staff following the death of a 21-year-old intern at Bank of America Merrill Lynch." I actually started my career in investment banking, and I can vouch for the fact that the hours are ridiculous. They are grinding. They will challenge anybody's health and sanity. But I think it's useful I have no problem with maybe overhauling the culture of pushing interns in particular, but even analysts and associates to the extent that they're pushed. However, it's a trade-off. There's a lot of money to be made for, and these are recent college grads who, and this was me too at the time, know nothing about nothing, and they're getting paid a lot of money, and a big part of that is the poor work-life balance and the long hours. And I think it also helps to put this in perspective a little bit. Over here in the U.S., OSHA reported that in 2011, 4,609 workers were killed on the job. And that was in 2011. That's 13 deaths every day. Of the private worker deaths, there were 738 in construction. So we're talking about 2 workers dying every day in the construction industry. So, I mean, I don't want to minimize any time somebody passes away under these circumstances. It's terrible. But let's think about the bigger picture here.
Yeah, I don't see the culture changing too much. They say there's going to try to overhaul the culture here. Like you mentioned earlier, it's really a supply and demand thing. If there's people out there, young people out there that are willing to work this hard and work these hours, it's going to be done, whether they say they're going to change the culture or not. It's really a supply or demand job market.
It's a very sad story, but like I said, I think looking at the big picture and thinking about some of the perspective helps there. Moving on, we're winding down to the end of earnings season. And so while we don't have as many earnings reports to look at, we are getting the quarterly filings with the SEC that include a lot more information than we get out of the press releases with the earnings reports. So you and I were looking at the Bank of America 10Q, their quarterly report, and we'd come up with a few things that readers might not have heard about, might have missed. What's the first thing that you came up with?
So if you remember, back in March, we had extensive coverage of the Fed stress tests and the CCAR results, which were banks submitted their capital plans, basically their plans for dividends and stock buybacks, for the next 2013, for the next year there. Bank of America, theirs was not objected. They were approved by the Fed for a $5 billion share buyback program that goes through the first quarter of 2014. So now, halfway through 2013, they've used only about $1 billion of that authorization there. So they still have $4 billion authorized through the Fed to go out there and buy back their own stock. This is a good thing, I think, for investors, for the bank, because if we talk about the book value and the book value declining because of some of the securities on their books decline in value when interest rates go up, we saw that in the second quarter. The bank can offset some of that on a per share basis by buying back some of their shares. So they have a little bit of wiggle room to support the stock price from that perspective, I think.
Well, even more so than supporting the stock price, personally, I think that shares of Bank of America are still a little bit undervalued if we think about the opportunity for the bank to kind of take some of the expenses out and improve operations going forward. So I think in terms of companies usually screwing up share buybacks, buying high and selling low. I think this is a good opportunity for Bank of America to be buying its own shares low. One of the things that I found in here that investors may have missed, they call it a subsequent event. So after the end of the quarter, here something that happened. And this was July 17th. The UK 2013 finance bill was enacted. That's what the filing said, and that reduced the corporate income tax rate by 3% to 20%. Sounds like good news, right? It is to a large extent because it'll lower Bank of America's UK tax rate going forward. And when we think about the other major US banks, Citigroup, JP Morgan, we'll do the same thing for them. On the other hand, though, Bank of America had a bunch of loss carryforwards that it was holding for its UK business, and with a lower tax rate, there's less to offset with those. So in the September quarter, Bank of America will record a charge of $1.1 billion against these loss carryforwards. So investors want to be prepared for that. Probably want to understand where that's coming from, that it's a non-cash thing, and that the change in income tax rate will be an ongoing benefit, but have this big knock right away.
Right. And
we could also point out that, again, Citigroup and JP Morgan, their shareholders could also be looking at the same kind of write-down.
Right. The one other thing that I pointed out was in terms of their capital levels. So we've seen the banks build up capital levels fairly significantly over the last couple of years. And this was, I think, after the quarter, or just as they were reporting earnings, those new leverage ratios came out. And I know it's confusing when we talk about Basel I, Basel II, Basel III, leverage ratio. What do they all really mean? The proposed leverage ratio from the Fed was basically trying to simplify the process and saying just equity over total assets, not taking into consideration this risk weighting, what's riskier, what's not risky. So they just wanted to look at equity over assets. And they set it as for the bank holding companies. So Bank of America, they're a bank holding company. They have all these legal entities under them, such as the bank, Bank of America National Association, and their card services. So from the bank holding perspective, the Fed set it at a 5% buffer. In the 10Q, Bank of America came out and said, we're right at the 5% buffer. And it's worth noting that these wouldn't be effective till 2018. So Bank of America seems to be in a good spot from that perspective. At the next level down, at the FDIC level, at the actual bank level, the Fed proposed a 6% leverage ratio there. And Bank of America said they're well in excess of the 6%. So again, just some more good news on the capital front. One less thing to have to worry about from a capital, from a liquidity perspective. They seem to be in fairly solid position.
And let me finish off with this. We've talked about this before, and the rising interest rates, or the threat of rising interest rates, continues to be something that's, I'll say, spooking the market, for lack of a better way to put it. In the quarterly report, Bank of America, like the other banks, includes a sensitivity analysis looking at what happens with various interest rate shifts on its net interest income. So this is the impact on the entire business, but that net interest income line on the income statement with a 100 basis point instantaneous shift. This is a parallel shift, so both the short end of the curve and the long end of the curve, both going up 100 basis points. Bank of America would be looking at an increase in net interest income of $3.3 billion. If we go down to flatteners, so these are changes that would flatten out the interest rate curve. So if the short end of the curve comes up to flatten out the curve, Bank of America would see a $2.3 billion improvement in net interest income. If the long end flattens out, that would be the long end coming down, Bank of America would see $662 million decrease in net interest income. And then finally, if we go to the steepeners, so making the interest rate curve steeper, if the short end drops further to steepen it, Bank of America would lose roughly $1 billion off the net interest income, and on the opposite end of the spectrum, long end steepening going up further, $1 billion benefit. So again, what we see here, the big picture here, is that to the extent that interest rates are going up, they will cause some short-term pain on the balance sheet, but the longer term, the improvement in net interest income. This is what the operating business wants to see, and so I think the rising interest rates are actually better news for the banks on balance.
Right.
Moving on to our game for the day, and the game is, what would Warren do? Warren Buffett, one of our favorites around here in Fooldom. David, I'm going to present you with some scenarios, and you're going to tell me what Warren Buffett would do. Number one, it's late August. Right now it's late August, and the market has been slipping. The season, that is, not the fall in stocks. The fall is often not a great time of year for stocks. What would Warren do?
He would pay no attention to the change of season. Warren Buffett, obviously a very bottoms-up investor, so he's looking at companies that he likes, that he finds attractive. He's not looking at the time of year. He's maybe looking at kind of where the market is as a whole, but largely I think Warren Buffett's very focused on, does this company's business fundamentals look attractive? Is this a business that I can, if he's acquiring the business, can I plug it into the Berkshire model and be successful with that? If he's just buying shares, is this a business that he wants to hold shares in for the next 10, 15, 20 years, even after he's gone from Berkshire Hathaway? So I don't think he's paying mind.
That was an easy one, David. That was a warm-up. That was just a test for you. Let's move on to number two here. Number two, both B of I Holdings, the holding company for Bank of the Internet, the internet-based bank, both B of I Holdings and Zillow are in your portfolio. Theoretically, they're not actually in your portfolio, although Zillow, I know, is. Are in your portfolio. Both have been hot stocks over the past year, but both look very expensive today. What would Warren do?
Assuming that he was holding both these in his portfolio, he would have bought them with the assumption that he's going to hold them for a very long time. Zillow recently public, just a couple years, B of I a little bit older. But even if he bought those and they've climbed to these valuations, which are a little bit rich, I think he would still be holding on. I think he would have a bigger vision than just this run-up of 100%, 200%. Even though it's a lot in our short-term view of it, over the long term, I would assume he bought these seeing the potential for 10-bagger, 20-bagger over the next 20 years. So unless he saw really attractive opportunities to put his cash elsewhere, I don't think he'd be selling here.
Buffett is known as a value investor, but he often doesn't function like we think of the typical value investor. He actually faced a lot of criticism in 2000, right around the internet bubble kind of time. Coca-Cola's stock went through the roof. It was trading at a very high, very rich valuation. And Buffett stuck with it. He didn't sell. And he faced a lot of criticism for that. And in retrospect, I believe what I remember him saying is that in retrospect, he maybe should have trimmed some of that position at the time because the price was so high, but he didn't. So I guess going back to Ben Graham and the parable of Mr. Market, the parable has two sides to it. So the one side is that sometimes Mr. Market gets extremely pessimistic and is willing to sell stocks at well below their intrinsic value. On the other end of the spectrum, Mr. Market gets very, very excited and sometimes sells stocks way above their intrinsic value. Problem is that measuring intrinsic value can be very difficult, so you want to give yourself a lot of buffer in there. And so unless it's obvious that you're way above what that intrinsic value is, I would assume that Buffett would hold because he's a business investor. So when I think about both of these, in my opinion, Zillow may be beyond that, possibly. B of I Holding, I think you can still get decent returns from it, even at the valuation today, particularly if it continues on the growth path that it's on. So I think that one would be worth holding. I'm not crazy necessarily about buying it today. Number three, JP Morgan is in your portfolio and it's ending up splashed on the front page for bad reasons day after day. What would Warren do?
He would be disappointed because the stock isn't dropping that much. I think he'd want to buy more of this great company. I think he holds it in his personal portfolio, not in the Berkshire portfolio. Yep. I think he would be disappointed it's not falling. I think he'd want to buy more, and I think he'd also call up Jamie Dimon, his friend, on the phone and say, hey, any reason I should be worried? I think Jamie Dimon would say, I know it's annoying, you don't like to see your investments in the news, but we're going to get through this. We still have a great company behind us. Stick in there.
Wouldn't it be nice if we could all get Jamie Dimon on the phone like that? Finally, finishing off number four, you find yourself in a vegan restaurant, and the closest thing to soda is kombucha. which of course is a fermented tea that tastes like vinegar. What would Warren do?
He would not be in a vegan restaurant, I don't think.
No. You're already in a vegan restaurant. You can't squirrel out of it by saying it wouldn't happen in the first place.
He would pull out the checkbook, write a check, give it to the owner, buy it on the spot, and get the cherry Coke rolling in. He would take that out of the way.
All right, I'll give you that one. All right, finishing off here, we're going to head to the Twitters as always. And David, I will let you take us out on the Twitter sphere.
Alrighty. So we can throw the first one up there on the screen. Got it from our own Jordan Wathen. 16% of homes went to investors. U.S. existing home prices rise 6.5%. And he links that to the Bloomberg article there as well. So I thought it was interesting from the investors' perspective. 16% went to investors. That's down from where it was last year. I think it was 22%, it said in the article. So it's kind of a trade-off in terms of these cash investors. So a lot of times the people that are buying homes as investment on speculation, they're not going out and getting mortgages. They're using cash. We saw Blackstone come in and buy a ton of homes using cash, not necessarily financing that deal there. So with these cash investors leaving the market, that may present some opportunity to just regular home buyers. They don't have to compete against these cash investors anymore. So it's still 16%, still significant in the marketplace there. But to the extent that that comes down a little bit, I think that'll ease the worry of some people thinking home prices are getting a little bit ahead of themselves. Maybe these higher mortgage rates will cool that down. So I think you'll have mortgage rates cooling it down, less investors cooling it down a little bit, and I think it'll be a more realistic housing market than what it's been the last couple of years, a more normalized, if we ever have a normalized housing market. So I think it's overall good news for the average home buyer out there.
I think you saw a lot of the influx of the investors, particularly the Blackstones of the world, because the opportunity was just too good to pass up. And as we approach sort of a normalcy in terms of prices and potential growth, I think they exit because there's better opportunities for their money out there as opposed to the U.S. home market, which is a broad and liquid and giant market.
Right.
So I think that's why we're seeing them leaving. There are a lot of people who kind of said, oh, it's a bad thing that investors are in there buying up these houses. But the way I look at it is, at the end of the day, you've got household formations, you've got people being born, you've got kids moving out of their parents' houses. You've got this activity that goes on that means people need somewhere to live. Now, those people may be buying the houses themselves for them to live in, or maybe an investor owns it, a private investor, a Blackstone, it doesn't matter, but somebody's going to be living there. So at the end of the day, we've got growth in population, we've got a growing need for housing. I don't really care who's buying it. It's got to be bought.
When we look back at the bubble, I think it's easy to say we're going to get back to that kind of abnormality of what was in the market. I think as long as you have
framing effect, or the recency bias.
Right.
It's all about what just happened.
And the fact that banks are out there and not making, hopefully, not making as risky of loans, subprime loans, the market has a lot of mechanisms to somewhat self-regulate itself. Not regulate, but in terms of offsets, so investors leave the market, that won't have, the competition will cool down in terms of for those actual home buyers that are going to be living in the house there. So the market does have some natural offsets that come and go. And as long as underwriting standards remain tight, it should remain somewhat in check, assuming that people's expectations don't get too crazy like they did in 2006, which was coupled with crazy expectations and loose underwriting standards. So as long as we keep those in check, things should stay fairly normal, but We'll see. Next one we got here is from SNL Financial, I believe. We got Roger Nyack. He says, my wrap-up of a terrible quarter for mortgage REITs. And then he links out to a useful chart out there. It might be hard to read on here, but we'll link to this tweet below, and you can check out Roger's chart there. I thought it was a good write-up showing the difference between these mortgage REITs that invest in agency mortgage-backed securities, such as the Hatteras of the world, the CYS, Armor. Also, their book values crushed, almost 20%. Actual over 20% in Hatteras' case. He made a very interesting point that a couple of the funds that invest in commercial mortgage-backed securities actually saw their book values rise in the second quarter. And he points out Starwood Property Trust, ticker STWD. And the question might be, well, why did theirs increase in book value? How come they weren't as susceptible to the rise in interest rates that hurt all of these agency mortgage-backed securities? And the reason is that commercial loans are a little bit more insulated from this prepayment risk. So when interest rates go down or go up, that changes the value of that underlying security. Commercial loans, they have penalties if you prepay or refinance at certain levels. So these commercial mortgage-backed securities not as exposed to wild swings in interest rate moves. So I thought that was interesting, a good point to make out the difference between these agency mortgage-backed security REITs and the ones that have commercial mortgage-backed securities there. It still sports a 7% dividend, so you're not getting quite the massive dividends of some of the mortgage
double
REITs.
digits.
No 15, 14s, but I thought that was an interesting point that Roger made there.
I've got nothing to add. It's been a terrible quarter to be an owner of mortgage REITs. It's been pretty brutal.
Yeah. Okay, the last one we will wrap up with about Bank of America from
yes.
Rick Rothacker. Latest closure at Bank of America, drive-up lanes, and then he links out to my hometown newspaper, the Charlotte Observer there. So we've seen Bank of America, they're closing branches. Now they're closing the drive-up lanes. Can't do banking from your car. Not at all the branches, just at some of their branches there. Just further efforts to reduce the cost, reduce the footprint of their branches. As a customer, maybe it doesn't make me too crazy. One less option I have if I'm driving. As an investor, I'm not an investor in Bank of America, but I know you are. I would be pleased with it. It's just further evidence that Bank of America is making the right moves in terms of reducing that cost, hitting those targets they made with their Project New BAC. They're targeting $8 billion a year of savings by mid-2015, and they should have around 75% of that done by the end of this year. So they're making good progress in terms of getting those expenses out, and I think it's just the natural progression of banking. We're not going to have as much brick and mortar anymore.
As a banking customer, when is the last time that you pulled up to a drive-through lane at a bank?
Last week.
Are you serious?
I did.
It's been at least 5 years since I've driven up to a drive-through lane at a bank, and I may not be the typical banking customer, but I just think we're seeing this unstoppable shift in banking towards the online, towards the mobile. And this is such a great way for banks to contain costs. The branch banking doesn't go away fully, but I think we continue to see efforts like this that'll slim it down. And at the end of the day, I think there are going to be a lot of customers that are very happy about having great tools available on their phone, on their computer, to do their banking without ever having to leave their house, is what I'm trying to say, without ever having to leave their house, rather than go to sit in their car in a line at the drive-through at the bank, or go stand in a line at the branch at the bank. So I think that this is a win for investors, maybe not such a loss for customers.
Yeah, and on the customer side, you might think, okay, they're ripping more services away from me. But if they can right-size that model and reduce even the size of the branch, reduce the cost around that branch, they may be able to, maybe they'll reduce the prices around some of the products associated with actual branch banking. So if you think about a safe deposit box that has an annual fee, if they can right-size that model, get some costs out, maybe they'll reduce the costs on you. Maybe,
then,
from a competitive perspective, they may.
It's a win for everyone.
Exactly.
All right. For David Hanson, I'm Matt Copenheffer. Thanks for watching.